Hey everyone, I want to welcome you to this, the new episode of the HX podcast. I'm really super excited about this one. I have an old friend of mine. We haven't talked in a few years. We used to talk a lot decades ago.
Yeah, a long time ago.
Just putting an age on me here. We're joined by hashtag legend technical analyst John Roque. John, we first started talking in the late 1990s when you were and I'm going to get the pronunciation of this wrong, Arnold S. Bleischroeder.
Good enough.
There we go, talking about technical analysis. And then John actually went on to go work on the buy side for a number of years at Soros and then with Scott Bessent's fund after that. And then most recently, he was at Wolf Research, and now he's working with friends of mine over at 22V. First off, John, how you doing? Are you excited for baseball season? I know you're a big baseball guy. So
I am. I'm excited to be here. I'm excited for baseball season. I'm doing great, and it's wonderful to see you. It has been too long, so renewing old acquaintances, talking about technicals, talking about the market. I maybe watching a baseball game. I couldn't think of anything better.
Exactly. I was actually going to put the Yankees game on. I forgot. I got the notice from Yes that it was going to be on. But real quick, before we get into it, we're going to talk baseball. What are you a Mets fan, Yankees fan, Phillies fan?
I do something a little strange. I root for both.
Okay. No, that's not strange.
And we watch both in my house. So the summertime, baseball's our best friend. My wife's a big fan. She'll sit there and watch the games. So
nice.
Yeah, it's like seeing your best friend every single day.
Oh, that's very cool. No, I will literally have the Yankees game on the rest of the season. I'll tell you the funny story, and this is where we lose all our viewers, but they'll come back. So I was always a Yankees fan since '77 because of Reggie Jackson.
Yeah,
then for many years, I was a Dodgers fan just because I wanted a National League team, and I kind of grew up out west. I grew up in Arizona, and so I was never a Diamondbacks fan. Because I left before they got there, and then friggin' 2001 and that travesty and all that. But in the last 5 years, I became a Diamondbacks fan because I was living in Arizona, and I was like, they're miserable. They suck. No one's going to root for the Diamondbacks. And then I became a Diamondbacks fan, got season tickets just in time for them to go to the World Series.
Wow.
So now I'm Yankees Diamondbacks. I'm actually headed to spring training tomorrow afternoon with my son to go to see a game. It'll be his 10th year in a row. Every year of his
fantastic.
life.
And you have Corbin Carroll's a terrific player.
Corbin Carroll is a great player. Yeah, no, the Diamondbacks are going to be great. Okay, So today we're going to talk about technical analysis. Okay. And, what I want to do is for our viewers, I'm going to give a little bit of an introduction on my views of technical analysis and also my history, because it's kind of a strange one. And then I'm going to kind of go through my little soliloquy, John, but then I want you to come in and kind of give your history, your views, your background, etc. So, coming out of Wharton undergrad and coming out of where I did banking and Tiger hedge funds, etc., technical analysis was always this like voodoo bullshit, okay? Completely dismissed in the fundamental circles, which, whether you take Fidelity, Peter Lynch, Tiger Cubs, you name it, outside of real pure traders, like, which I throw maybe Steve Cohen in there, but even then there's a ton of fundamental guys. Yeah. It really was dismissed. But I very early on had read a lot of books, like the William O'Neill books, things like that. And there were a lot of things I was a believer in, and I was like, okay, this makes sense. And we'll come back to that in a second. But I got to tell you, my entire career, my professional career, it was really hard to embrace technical analysis because of my partners and because of my investors, which is I kind of sat there and I was like, I think there's something here that could be really useful for my money making, but all my partners are like, technical analysis is bullshit. All the people that were investing with us didn't buy into it. And so it was hard to really put into our process because I certainly couldn't talk about it with institutional investors. Right. We would have got a lot of pushback. So through time though, and especially as I left money management full time and then began writing newsletters, I really began to embrace it more. And, especially when Whitney and I launched Empire 5 years ago, I said to myself, okay, now I don't have these boundaries. Let me dive in. And I'll tell you, for our newsletters today, they are at least a third technical analysis based. And what my view of technical analysis is, and like I said, I'm going to go on my soliloquy and I'm going to shut up. I don't want to hear your thoughts on this, is, to me, what it does is it gives us the information that we couldn't know from the bottoms up, but gives us it from the top down. Meaning any given stock has thousands, tens of thousands, hundreds of thousands, occasionally millions of participants. They all have their views and beliefs and levels of enthusiasm, etc. And while we can say that consensus is this about earnings or the sentiment is this, etc., the price doesn't lie. The price tells us what that balance is. The price shows us those patterns. And what happens is I feel like price patterns, they're like physics. It's like the ocean. You know, the tides might be a little bit different here and there, and what's on the surface of the ocean changes, but the tides are always the same. They go in these patterns. And so what we do is we really look at that to say, this is our way to know the unknowable, which is what is the balance of enthusiasm of buyers versus sellers? And then we use it to guide a lot of the strategies that we do. So that to me is the framework, the intellectual framework that price tells us what all of these people are thinking and doing. And that's why it makes sense. And we'll jump into some of the specific things in technical analysis. But this is my long, strange journey with TA. I want to hear from you. When did you start learning about technical analysis? How did you get into it? What's been your reaction that you've seen from professional investors back in the day and today? And then why do you think technical analysis works? So,
okay. I enjoyed listening to your soliloquy in your phrase, in your word, in your verbiage, because I think that is kind of the way the kind of acceptance wave has been within the business since we've been in the business.
Okay.
So I got to it in a rather, kind of backdoor fashion. I worked for a small research boutique in White Plains, New York. I worked for a guy named Ken Safian. And he, in the late 60s, along with his partner, Ken Smilin, had one of the top research boutiques on Wall Street. They were a macro research shop. But he was, for lack of a better phrase, and I say this with all due deference, and this is not pejorative at all, he was a closet technician.
Okay.
Which meant,
I think was very common, by the way. I think that's
correct.
actually probably the most common kind.
Correct. And so what he would do is, and this is a true story, this is not fanciful, he would hire high school and college age kids to come to his office on a Saturday morning. They would buy their own copy of Barron's, and that used to be the weekend Bible.
Yep.
And they would get the weekly high, low, and closing prices and volume from Barron's, and they would graph that on giant pieces of graph paper, and it would be in a giant binder, and he had this kind of giant binder bookshelf.
Yep.
So Ken Safian would come in on a Monday, and he'd go through these books, and you'd hear, because the big graph paper was kind of going over, and he would make a list, and his list would be, plus sign, minus sign, and he would actually come to some macro mindset as to what he saw in the charts. For example, and this will resonate with you and with people who are listening. If he went through all his charts, and I don't know, we'll just make a number up. If he reviewed 250 and he found 18 that were chemical stocks, he'd say to himself, what's going on in the chemical industry?
Yeah.
It was kind of like Druckenmiller's phrase, price discovery, right? There was price discovery, information discovery from the charts. And then what he would do, Rick, after making those lists and making that decision, he'd go and look at all of the economic series for chemicals.
Yeah.
Pricing, PCE, CPI, PPI, whatever macro series there was. And then he would come up with some sort of decision. And he would kind of then proceed in that fashion. So,
can I say a couple things about this? Because it's interesting. We used to get these chart books, and I want to say they were from IDB.
IBD. I used to get them.
Yeah, Investors Business Daily, IBD chart books. And we used to get them when I ran my hedge funds. And I used to do the same thing. And I did it almost as like a meditative practice because I wanted to do it quickly. I didn't want to spend a lot of time thinking about the chart. I wanted the chart to speak to me very quickly. Correct. And what I would do is I'd go through, there was 1,000 charts, and I'd draw lines. And I wouldn't spend more than 1 second because I needed the chart. If the chart told me something in 1 second, then there was something worth telling. If the chart didn't tell me something, I moved on to the next one. Right. And then I would go back and go through all the charts that told me something, and two things would happen. Number one, I would begin to get a sense of what the market was thinking, because like him, I would be like, okay, utilities really seem to be moving higher, or whatever it is. Number two, I just find a dozen ideas where it's like, I hadn't thought about that company in forever.
Exactly right.
But there's one other thing that I think is so fascinating about this. You're old enough that you'll appreciate this, but I think a lot of my viewers and readers don't understand this. When we started, Bloomberg was here, but the ability to go get all these charts and go on the internet, and there was no internet. There was barely an email. If you wanted charts, you literally had to order you either had to chart it yourself, which I was young enough that we didn't. I didn't have to chart myself, but you would get these books that you'd get once a week, and you'd have to go through. And so when we talk about how the world has changed and opportunities, et cetera, this evolution is so massive. But let's go back to Ken. So he's hiring these high school kids to come in. Were you one of the high school kids that he hired?
No, I was not. Okay. So I got my MBA at Fordham, and I awesome. I wrote a thesis paper on Connor peripherals. I got a good grade. I sent him the thesis paper. Because, Enrique, and this will really age me, we used to look for jobs in the back of the New York, in the help wanted area in the New York Times.
Yeah, absolutely.
So I sent him my resume, I sent him a cover letter, and I sent him my thesis paper, and he made a job offer. So I went to work for him, and I didn't know anything about technicals, and I certainly didn't know anything about macro at the time. And he was a great teacher because he allowed me to do everything.
Right.
And I was very thankful for him to do that. And so I got exposed to a lot of technicals there. I started to make my own indicators. I started to keep my own data series. And as simple as this sounds, or as childishly ridiculous, if you were using your own graph paper and a pencil and a ruler, and a stock broke out above the top of the page, and you'd have to cut a piece of graph paper out and glue it on so that you could continue, that was perhaps the most bullish thing that could happen for somebody who was graphing stocks by hand. Or conversely, if it broke to the bottom of the page and you had to add something on to graph it again, that would be the most bearish thing you could find. So these were kind of, I would say old wives' tales, technical signals, no offense to any old wives. And so you got kind of a feel for this. And I would tell you, I still input my data, NYSE advancing declining stocks, NYSE new highs, new lows, NYSE advancing volume, declining volume on the floor, NYSE advancing volume, declining volume off the floor, total volume on and total volume off. And the same thing for NASDAQ. I still put those numbers in my spreadsheet by hand every single day.
Okay.
And what I have come to understand is by doing that by hand, you get a feel for the data. You know when there's a mistake. You know when there's an outlier. You say, wait a second. There's something odd with this data now. Did something change? And like you going through those IBD charts, by putting in that data, you get a feel for it. So somebody can say to me, John, this rally has looked very narrow. And I'd say, I don't agree with that. The rally has been quite broad. Breadth has made a new high. This is as good as kind of you want it.
This will be off topic to investing, but partially on topic. I spent a lot of time understanding behavioral psychology and all this stuff. And one thing I learned very early on, I was in college. I used to go and I would take notes in the lecture or whatever that I was at. I didn't go to many of my classes, but I would take very, very extensive notes. And then I would go back and I would rewrite the notes every single time. I would basically scribble the notes and then I'd go and transcribe the notes. And what you find out is that your retention of something that you write, if you rewrite it, is 5 to 10 times. So there's actually you are doing something that mentally is incredibly powerful. That what you're doing is, it's one thing to go look at the chart, it's another maybe to jot a couple notes, but if you systematically force your brain to go through and do this, you're really kind of putting this in a process. So I'm not surprised that you find that powerful.
I actually did the same thing, Rick. I did the same thing in school. I would rewrite my notes, and I found as I got closer to the tests, I would rewrite them in such a fashion that I could get the concepts down to perhaps a sentence fragment, and then I knew I understood it. The smaller my notes got, the more I recognized that I understood the topic and was prepared for the test.
I used to before the test. Well, at Penn, they actually had this thing where they sold the old tests. So I figured out that these professors didn't make up new tests, so it's basically like I had 10 years worth of tests, but I would stay up for 8 hours before the thing, take all the old tests and just reread the notes. So let's go. So you're working with Ken, you get into technical analysis. Run us real quick through the career, but then I want to come back, bring us all the way to here. And why do you think this voodoo works? Okay.
I left Ken Safie and Safie Investment Research, and I went to work at Lehman Brothers for a guy named Steve Shobin, and I was there for 4 years.
Absolutely. What years were you at Lehman, by the way?
94 through 98.
I was there from 94 to 96. So we were actually at Lehman. That's why we didn't talk at the time. Yeah.
So I thought that Lehman was a great place to work. And Steve Shobin was as kind to me as Ken Safie was. And Steve Shobin let me do a lot of things. And I, at the time, was in charge of doing technicals on international markets. So all the things that were built on the U.S. market, I built them for all the international markets.
Did you know Alan Tannenbaum, who ran the international sales desk? Alan's a great friend. I remember Steve. I worked with Mark Paley on Equity Syndicate.
Alan's the sales guy for me because he was on the international side. Exactly right.
Absolutely. I'll tell Alan you say hi. I talk to him on a regular basis.
Please do. So I worked there for 4 years, and then I went and I left to kind of become my own guy at Arnhold and S. Bleichroeder, which was also a fantastic place. John Arnhold, with whom I am still in touch and friends with, was a great boss, and a guy named Jeffrey Collier was also a great boss. And while working with Steve, I learned, a ton. I thought that I could finally be my own guy at Arnhold and S. Bleichroeder. And so Arnhold and S. Bleichroeder became Natexis Bleichroeder, then became Natixis Bleichroeder, so it had a vowel movement when it was then owned by the French. And then I left to join a firm that had moved off floor called WJB Capital. It was kind of an ill-fated place. Anybody could do the research. This is public. And it closed down. And then Scott Bessent made me an offer to join him at Soros. And I thought that was like being recruited by Dean Smith at North Carolina to play basketball. And I said, you can't say no to this. And then worked for Scott again at Key Square. And then left Key Square, went to Wolf, and here I am at 22V Research.
So let's talk about, to the extent you're comfortable, let's talk about the Soros experience, because I'm fascinated by that. I came out of the Tiger realm of things, and if you would have brought technical analysis up to Julian, I mean, you're getting kicked out of the room.
I understand.
So I was very uncomfortable with it. Obviously, Soros came from more of a macro perspective, but I mean, was technical analysis well respected at Soros? Was it part of the process? Were you kind of off in a room and they're like, "There's that weirdo, we got to talk to him again"? What was the story?
I'll tell you. So I'm going to tell you two stories. They may be apocryphal.
Okay.
So here goes. Number one, when this is what I've heard, I didn't hear this firsthand. This is passed down. This is Wall Street legend lore.
Yeah.
When Stan Druckenmiller first went to work for George Soros, Druckenmiller himself didn't know how to tell George that Druckenmiller was a technical guy.
Okay.
So he kind of had this, he was troubled by it, and he said, I'm going to tell him. So Druckenmiller leaves his office. He walks across the floor, and son of a gun, George Soros is walking toward him. And Druckenmiller said something like, "I was just coming to see you." And George said, "I was just coming to see you." He said, he reached into his back pocket and he said, "I have this chart I want to show you." And just at that point, Druckenmiller said, "Okay, I'm in the right spot."
Right. Okay.
And then the second apocryphal story is that one time a sales guy goes to visit Druckenmiller and he says, "Stan, I've never met a rich technician." And Druckenmiller says, "I'm a rich technician." So it was accepted at Soros. Okay. And it was accepted because I think that there's kind of the ethos of the place was handed down from George. And I don't know him at all, but I worked for both Scott and Robert Soros. In that George said, "Just give me enough information to make a decision."
Yeah.
And I think technicals helps that process. It's not everything, but it kind of pushes you in the right direction. And I'm going to quote Paul Tudor Jones here. He has a famous line, which is amongst my most famous lines in our business. He said, "Price turns and then a narrative follows."
Yeah, absolutely.
And I think that is generally the case. So there were a lot of asset managers at Soros. They did all sorts of products. Some did sovereigns, some did commodities, some did currencies, equities, etc. And so I was able to be exposed to all of these folks. And I would tell you, I think that Soros was amongst the more open-minded places I've ever worked at. I thought it was a fantastic place. They treated their employees well, and they were open-minded. They wanted to win, and they accepted it.
I think what Soros did, I was something, when Whitney first asked me to join him at Empire, I mean, we were having a conversation, and he goes, what kind of investor do you consider yourself? And I said, well, I consider myself a make money investor. Like, my job is to make money. So if value is what I should be doing, if charts are what I should be doing, if growth is what I should be doing. Now, the reality is through time, I have a very well-developed methodology that makes me money. It's a multivariate methodology, and it also changes throughout the cycle. But I think Soros had very much a make money mentality about it. So let's do this. I don't know if you have a good answer for this. This is a tough one. You've got your in-laws, okay, and you're trying to explain what you do. You're trying to explain technical analysis. You got your in-laws. You got Matt, who's recording this for us, a member of our team. How do you explain? So they go, and this is the sophisticated investor does the same thing. They go, well, so you're just looking at a bunch of charts and you think you know what the stock's going to do? How does that work? How do you explain that intellectually to someone?
Okay, so here's the way I think about it. First off, I'd like to say I'm not a trader. I think I'm a trender. Okay. And I think technical analysis works best from a trend perspective.
Okay.
That's number one. So I am trying to find where the trends are easiest for me to be involved in. And so I'll look at it like this. I'm going to make this analogy. We go to a baseball game, and the score might be immaterial, but you're able to take a look at the players on the field, and you might say, my gosh, that guy really does run well.
Yeah.
Oh, look at this guy. He didn't have a hit today, but man, he hit the ball hard 3 times. 2 times was a line drive. 1 time was a scorching, ground ball up the middle. The shortstop made a diving play. That guy really can play. Oh, look at that outfielder. He really went and got those balls. Those guys may not have done anything to be in the box score where they scored or they had 3 hits or their names in the headlines. But you say to yourself, my gosh, those are good players. Okay. And so I'm looking for particular setups. I have my own particular methodology where I think I have a better chance of winning. I do not play in all stocks. I do not play in all assets. I do not play in all setups. What I do is I try to find the setup that allows me a greater chance of winning. And that setup, Rick, and I'll tell you, the setup is that I like to find what I refer to as big bases. You will appreciate this. If a stock works sideways for a long period of time, I will confer upon that the nomenclature of building a big base. The building of a big base is the fundamental orientation of new management, new product, paying down debt, consolidation in the industry, better pricing, new products, etc. The big base says to me, I could call you up and say, Rick, there's this big base in healthcare. It was basing for 8 years. It's finally broken out.
And let me just do something for our listeners. When he's saying a big base, it means that a stock is traded it doesn't have to be that narrow of a range, but in a range for an extended period of time.
Correct.
The stock's traded between 15 and 25 for 3 years. That's what you mean, like numerically by a big base. That's correct.
So an example right now is, and your listeners can see this, is UHS, which is Universal Health. It finally broke out of a wide swinging base. I mean, wide.
I'm going to take a look here on my chart.
Take a look. Take a look at it on a monthly and you'll see it. It finally broke out of a wide swinging base that was big and lengthy, and now it's broken out. So I try to find these big base scenarios. So that to me would have been a player for some time that did not have a big hit, did not score the winning run, but was kind of preparing itself to be in a position to have a big hit or to score a run to win the game. So if I were to make it even, simpler, if it isn't painfully simple already, is I try to find the proper setups that allow me a greater opportunity to win. I increase my odds to win. Within those big bases, the stock should A, be above an upward sloping 12-month moving average.
Okay.
or be above an upward sloping 40-week moving average, which corresponds to a 200-day moving average. If that is in place, I have a better chance to win.
So I'm going to take some of the stuff you said, re-say it kind of in our nomenclature, but also to explain it. Fundamentally, you believe, and you've proven out, that you can look at patterns in price and identify setups, a combination of events that are a combination of those patterns, with a number of different variables, distance from moving average, length above moving average, length within a price range. Well, put those aside, whatever those variables are, and that give you a higher probability bet to predict the next outcome or the most likely group of next outcomes. Not a certainty, because there's never any certainty.
Not a certainty. Not a certainty. Yeah. I'm just trying to put the odds in my favor.
So I use the example, and I'm sure you're familiar with this example. It's like blackjack and counting cards, right? Is that the cards come out, and we know if there's there hasn't been a bunch of face cards come out, that the probability of a face card coming out next goes up. So to a certain extent, and I'm doing the very simple version of this, you're saying that one of your preferred setups or your preferred setup is find a stock that has a really, really big, nice base that is still reasonably in an uptrend. Again, this is the relationship to the moving averages. And then I'm guessing you're going to look for some sort of breakout out of that base, but we'll come back to that. But that's sort of your version of, okay, I'm going to start to see some face cards out here. And so I want to put more of I want to play. It's almost as if in blackjack, you could choose to not play at all, and then you can choose to play, which is kind of what you can do with stocks.
That's correct.
Is that a good analogy for how you're...
That is a good analogy. And that is a good analogy. And I'm going to use another one. Jim Rogers said it most famously. He said, I never make a trade until I see a pile of money sitting over in the corner. Okay. And then I make the trade. Yeah. And that is your analogy, and that goes back to the base setup, correct?
Got it. Well, so let me walk you through this. I'm going to do this. I've never done this with a technical analyst, by the way. Our methodology at HX Trader, it's very, very straightforward. This is our equity trading newsletter. We're looking for big liquid stocks, at least couple ADTV, average daily trading volume of 5, 10, 15 million. So it doesn't have to be crazy. And we usually are looking we go into the equities. We're usually looking to hold it 30 to 90 days. Okay. We historically have had like a 75, 80% hit rate. And average about a high single digit return. But this is what I'm doing. I'm going to go through it super quick because you're going to get it. Yep. I'm looking for charts that look like this. Yep. That just means that are going up and to the right. We could put numbers on that, moving averages, blah blah. This is actually better for our listeners. Up and to the right. Look for the chart. If you look at the chart like this, you should be interested. If the chart goes like this, I don't know. If the chart goes like this, stay away.
Not interested.
That's one rule of life in chart. There's my biggest rule in technical analysis. This is interesting. This is maybe interesting. This is never interesting for being long. But then what we do, okay, we look for things that have well-established uptrends, and then we wait to see if we can find ones that trade through an RSI of 30 and then back through that RSI. So you're an uptrend like this, and then it's like wind shear. It's like they were sailing along something, and boom, and something got hit. And what the RSI is telling me, that below 30, is that whatever the event, skepticism, whatever happened was dramatic. To take a stock that's trending like that and go below an RSI of 30, there's some trauma that happens. And then what I do is I wait for the trauma to heal a little bit, go above 30, because, if you go from an RSI, well, who cares what the RSI is? You get an RSI of 30, 27, and go to 26, go to 22, go to 15, whatever. We wait for healing. But then from a fundamental perspective, and I'm going through this quickly, we look at the company itself, and we're looking for companies that are growing earnings, have grown earnings, that have beating numbers, have beaten numbers, have rising expectations. Well, these are companies we call winners, right? Because for me, what are we looking for? We're always looking for winners. What's a winner? A stock that's gone up, okay? So this starts with this. But then stocks that are winners generally are companies that are winners, companies that have been growing, beating expectations. And what we find is if you can find that technical setup, it's all technical, chart up to the right, RSI below 30, and bounce back through, and then you add in those pieces that you're able to find a situation that has those fundamental pieces, your hit rates are through the roof. Okay. You just, and look, sometimes you're wrong and you have to manage risk on it. But I'm curious, I've never actually walked a technical analyst through that. What do you think of that methodology? I mean, I know it works, but I'm curious how you would approach what I just said, and maybe you have tweaks for it. I don't know.
No, I think that's legitimate. Of course, number one, you win with it. Number two is it makes sense. So you find a stock that is, up and to the right, and the RSI is over 70, so it's overbought. And then you have a sharp corrective phase where the RSI gets below 30. So now it is oversold in a short, sharp period. And then the RSI starts to heal. To me, that's the example of buying a stock of a good company that is all of a sudden on sale. So I'm all for that. I found that over time, the guys, and I'm going to use you as my example, the guys on the fundamental side of the business, fundamentally strong investors, do their best buying when stocks that they love fundamentally correct back to an upward sloping 200-day moving average.
Okay.
They say to themselves, well, it's pretty cheap now. There's no change to the fundamentals of this business. I am going to buy it. I found that those guys who do that are often the more successful investors because they buy it, what they know, as it is on sale.
Well, so I'll say a couple things about that. I mean, first off, our strategies, in the trading strategies, we go back to the well all the time. Like, I mean, we just make, and my last hedge fund where I was the principal, we basically, what we said is we had fundamentally bottoms up stock picking, but then a trading overlay. And what we used to do is we would harvest volatility. So if we knew the company was good, we knew the company was going to execute, what we do is, if the stock was at 40 and it traded to 48 real quick, we'd sell a little. And then if it traded to 40, we'd buy it back. And if it sold off to 32, we'd buy more. And so what would happen through time, when you looked at our steady state portfolios, these are if we just held the stock and did nothing, we outperformed our steady state portfolios because we were constantly harvesting volatility while still capturing the overall move in the stock. So I'm curious, when you, like, let's say you're at a Thanksgiving cocktail party, whatever it is, do you get a lot of questions about technical analysis? How is your interaction with non-professional investors when you talk about what you do?
So when my friends will ask sometimes, or let's say even my kids might ask sometimes, I say something like this: I'm a bird dog baseball scout trying to find the next best player I could sign to my team.
Okay. And
so that would be a stock that hasn't yet broken out, but looks like it's going to break out. And then otherwise, I am trying to find steady performers that over time, despite corrective phases, remain in long-term uptrends.
Okay.
And so we do that in a variety of ways, Rick. Just like you said, you have your methodology. My methodology is, when I was at Soros, I built something I call a technical scoring system. And I will tell you, the inputs are much simpler than saying technical scoring system. I have 4 inputs, and when something scores a 3 or a 4, which means I'm solving for 3 or 4 of the possible inputs, then I want to be involved because the momentum there is strong.
We just real quick, at my last firm, Empire, we had something called Empire Elite Data, which had 5 categories, which did exactly what you just said. I just walked you through the 5 categories: chart up and to the right, the RSI, earnings growth, beating numbers and raising expectations. And what we would do is when we got 5 of those categories, we would instantly get involved. And we actually, my partner Mark, helped develop the Bloomberg API, did the API at CapIQ. He built my quant systems. We're going to be rolling out HX data at some point.
Wow.
We're literally 1 month in. We launched on February 1st.
Wow.
But it's funny
Exciting.
you say 4. We literally had, it was just 5 things. And then what I found myself doing was, for our newsletter, I ended up using it. I was coming up with companies that I would never, I had no idea. Mettler Toledo, I hadn't looked at it.
Yeah, so Mettler Toledo showed up for me today. Now,
did it? I'm going to look at it for a second.
Mettler Toledo showed up, but it is at the early stages. I'll tell you something that's more advanced. Agilent is more advanced. Thermoelectron is more advanced. IDEX Labs is more advanced. Waters is more advanced. But Mettler Toledo did show up for me today, early stages. The others are, and also Bruker is the best of them, BRKR.
And maybe we're going to do the opposite of what everyone else does. We're going to end talking a little bit about the markets. But your view, I'm going to go back to this because I do want to sum this up, is you take the information, the charts are information and a number of data points. And what you've seen is that you are able to identify a combination of those data points that's set up in a manner for you like big bases and breakouts from those bases while they're in an uptrend. And then you're able to do a high probability bet from there. And so what I'd say to I want to say this to our listeners because I think this is important. It's like data in any other business. If you see that it's rain, you run a hardware store and it's January and it's rained 6 days in a row, you probably know historically that you should go in and put an extra order of umbrellas, okay? Now, maybe that's an oversimplification because it's so obvious you should go order umbrellas, but you also have data. You can look back at all the Januaries that it rained 6 days in a row and what happened to your sales. Now, by the way, just because it rained 6 days in a row doesn't mean it's going to rain a seventh day or an eighth day or a ninth day. You might buy those umbrellas and you might not sell any of them because we go into a dry spell. But you're able to take data from what's happened in the past, in this case, the rain, the umbrellas, etc., and you're able to make high probability decisions. And I guess maybe that's an analogy that I'll use to describe technical analysis. The price and to a lesser extent, the volume, but because those are the two main things that we've got, right? I mean, technically, we also have volatility, which is a function of price and all that, but price and volume, it's this history that if you know how to read it and how to triangulate it, can tell us about what is probable in the future or more probable than random. I mean, does that make sense to you?
I agree with that. I will add in something that I do that helps me, and I would say it gives me kind of a fundamental look. And I'm not saying there are any fundamentals. Is that I will give a lot of weight to the way the group or the sector behaves. So if a group or a sector at that level is strong, well, then son of a gun, it's pretty easy for me to say that most of the stocks in that group are going to act in a homogeneous fashion as the group is acting or as the leader in that group is acting. Too short, and this is something that I just want to get the other side of it. It's not. I'm going to answer it like this. Most of the people in our business, or a lot of the people in our business, go like this. It feels like this to me, or okay. I think that this is going to happen because it seems like. I never say those things. I only want to be able to show it. And if a group acts well, I don't want to show short ideas in that group. I want to show long ideas in that group. If a group acts poorly, that's where I'm going to concentrate my short look.
Well, this gets back, and I use this analogy all the time. It gets back to my ocean analogy. Those groups in the market and the industries, those are the tides. Okay. And so I can't see the tides, by the way. I don't, you sit in the ocean, you can't see the tides, but you go and watch the tides and all the boats are moving in one direction. Now, that doesn't mean one boat might go the other direction, but the fact is when those tides are all moving together, I'd rather be going in the direction of the tides than against them. And, and this is, I believe, actually out of William O'Neill, is identify the primary trend in the market.
That's correct.
That's kind of your first definition. Are we in an uptrend, sideways, downward trend? And is it well established? Because that by its very nature is going to dictate the type of risk taking you should take.
Exactly right.
Identify the trend within an industry, uptrend, middle trend, downtrend. And then you can identify the trend of the stock. Because I will say this, it's funny you mentioned that in our trading, new publication, we do take advantage of corrections, rotational corrections in industries. And it's high probability, but it takes a while for those to work out. They're some of my more, they're really good opportunities, but for the most part, they're kind of frustrating because they might take 40, 60, 90, 120 days to work out versus if I find a correction in something that's idiosyncratic that has nothing to do with the industry, Those ones actually, for me, tend to be those are the best ones, the true idiosyncratic. Okay, but watch the tides. So okay, we're gonna sum up with something here. This is gonna be hard. Let's say you had to just say 3 things to tell that in-law, or that friend or that cousin. I mean, I'll tell you my 3 that I give to people. Okay, I say do the work. Okay, you got to do the research. You got to know what you're doing. Just read and learn and like do that. Munger was like, I never met a smart person that didn't read every day. I mean, I read stuff on the internet every day, but do the work. The next one we say is trade a lot or don't trade at all. Okay, don't get caught in the middle. You either need to be moving a lot or not moving in order to make money in the markets. But the last one, I think you'll like this one, is plan the trade, trade the plan. Okay, you go in. Know what you're trying to accomplish and what you're going to do if it works well, if it's not working and it goes poorly. And then, and this is the key, this is where everyone screws it up. You got to do the work to actually come up with a plan, okay? And then execute that plan. Because where people screw up, professional investors, it's amazing to me. They know what to do. It's just when the time comes to do it, to make the hard decisions, they can't get themselves to do it, and then they screw up. And that's inexcusable to me. So what would I'm putting you on the spot here, so you may or may not have them. What would be 3 things that you would tell regular people, investors, to think about when they're trading or investing?
Okay, so I'm going to say that my polite suggestion would be not to be a trader, because you can't be faster than any machine. You can't.
Okay.
Number 1. Number 2 is, when you're doing your work, and you should do it, you should try to do it using monthly charts.
Okay.
Not daily charts. Monthly charts, because it smooths out the trend and you're able to see it more clearly.
I was looking at this chart, maybe going to turn it into monthly. That's why I looked away.
Yeah, that's fine. I would concentrate on monthly charts. And number 3 is, I would always, to your point, get myself I want to understand what my out position is. Meaning, if I buy a stock and it goes against me, what's my stop? What is getting me out? If I'm short a stock and it goes against me, what is my stop that's getting me out? And to your point, I'm just going to add one more thing to what you said at the very end. I met this PM many years ago, and he asked me about a stock, whatever, XYZ. And I said, if it were in my portfolio, and I always answer the question, what would I do if I owned it? If I can't own it myself, then I say I don't have an edge. But I said to him, if it were in my portfolio and this is what it was doing, I would sell it. And he kind of put his head down and he shook his head, and I said, I'm not trying to be a wise guy, but I noticed your reaction. What can you tell me? He said, when you move houses and you have to clean out your house and you have to go into the attic and you have to throw away stuff and you have to figure out what you're going to take. He said, yeah. And he says, how aggravating that is and how time consuming and how draining it is? I said, yeah, of course. He said, that's what it's like for me when I have to sell a stock. He said, because I've done so much work on it. I know the management. I know the customers. I know the business. I know all the fundamentals. When I'm wrong and the stock is going against me, I find it so hard because I've invested so much time. And I think
it's his strength and his weakness, but go ahead.
I think technicals, or at least giving yourself a level to tell you where you're wrong, eliminates, the subjectivity there. It allows you to be more objective. And I found over time that the most successful people in the business recognize that they're going to make mistakes, and they don't allow their current mistake to affect them on their next decision, which is kind of like the way Derek Jeter played baseball. If he struck out this at bat, it did not matter in his next at bat. The next at bat was different.
I think an acceptance and embrace of failure and the inevitability of failure and how to manage failure. Managing failure is as important, if not more important, than managing success in investing, probably in a lot of things in life. And I'm going to leave you I'm going to go off what you said here. I'm going to leave you this one thing, because this came up with an investor the other day. I also feel that if you have an idea in your portfolio that is all you can think about, let's do it this way. I've said this to folks. You got 20 stocks. I bet you the stock that you're making the most money on, that you think about the least, you should double. And you should double it by taking the stock that you're spending the most amount of time on and mental energy, where you're making the least or losing money. Immediately sell that one and double the other one.
I agree
and
with that.
Do that process every month, every 6 weeks, every 8 weeks. Do it. It's a force curving, right? I don't care about anything else. I don't give a damn about the fundamentals. I don't give a damn about it. Just once every 8 weeks, go into your portfolio, say, this one's driving me nuts and I'm losing money. I'm going to take whatever my money I have left. And this one, I haven't even thought about this stock in 8 months, in a year. I'm just going to put more in that and then go the F away. That to me is like,
that to me is kind of like a Catholic going to a confessional, where you say, forgive me, Father, for I have sinned. And then you are unburdened because,
right. Absolutely.
You make an act of contrition and you confess your sins, and the priest gives you absolution, hopefully, and you move on and you try to repent. So I think what you're describing is the same sort of thing. You need to unburden yourself of the item that is dragging you down or dragging your portfolio down, and it allows you to be a freer thinker, and it allows you to be emotionally unburdened.
Yep, you have to put yourself in a mental place to win. So, okay, good. Well, John, I want to have you back on. We're going to talk next time. We'll talk a lot more about what's going on in the markets.
Anytime you want to.
But you know what I want to do? You and I have talked many times through the years. It's been over a decade. But what I really want to do, because we never did it, I wanted to talk philosophy, like what is technical analysis, why it works, how it works, things like that, which we did here. Because I think that it's very interesting what's going on in the markets, and we could talk about Nvidia and the Russell, but all that's going to change in a week, a month, a year. But what we talked about here, I think these ideas are things that will be true in a week, a month, a year, a decade, long after we're gone. I think that a lot of these rules of technical analysis or these guidelines, they're going to be here because they're still going to be humans. They're still going to be trading the stocks.
Correct.
Even the damn machines are still going to have humans behind them. Ultimately, there's going to be so, for at least for a while. And by the way, if it's all machines, I don't even care.
I just want to also just say that I'm glad you brought the machines up. So I'm fairly confident, but if somebody wants to tell me I'm wrong, I will learn. I'm fairly confident that machines don't do trend very well.
Okay.
I am also fairly confident that machines do trading very well.
Mm-hmm.
And so I think it's important for individual investors or any kind of investors to kind of take a step away from their machine, which we sit in front of all day long, way too closely, and say, what is the trend here? Am I fighting the trend? Back to your William O'Neill thing about the primary trend, because the markets go up 3/4 of the time, right? So I'll tell you which piece of information historically to me is almost among the least important pieces of information in the market. When somebody says, after this occurrence, historically, the market is up 60% of the time 6 months later, and it's up 70% of the time 1 year later. And so I went back to the 1920s, and I just wrote an if statement in Excel, and I said, what happened to the market, 1 year after this particular date? 1 year, any date in history.
Yeah.
Rick, the market's up. The market's up about
64%.
Yeah, 2/3 of the time, no matter what day it is.
Yeah.
And so the only time it's not up is when you're either in a recession or a bear market, and that's probably redundant. So I think knowing the primary trend, as Bill O'Neill said, bails you out of a lot of poor decisions, and the market's up about 2/3 of the time over the long run. So knowing that, getting in a good group, finding big bases, sticking with breakouts and long-term uptrends, I think it's a simple thing, but it's not easy to do.
I think it's way underestimated. Okay, John, I want to thank you. By the way, you're on Twitter. So 22V is institutionally focused.
Correct.
But you're on Twitter at @DaChartLife.
Yes, I went to school in the Bronx. So I went to school in the Bronx. I grew up in Mount Vernon. So it's at DA Chart Life. Somebody had the Chart Life taken, so I did
so you should
nomenclature.
You should follow John on Twitter. He's not that active on there, but he does put some real pearls of wisdom on there. I want to thank you, John. I appreciate it, and look forward. Maybe we'll catch a Yankees game.
I'd love to do it.
Season.
I'd love to meet up with you, shake your hands, and thank you to Matt for for coordinating all this. Thank you, Rick. Thank you, Matt.
Absolutely. Thanks, guys.